The stock market has been going wide, making a new low each week. 2025 has been a year of panic, starting with the release of DeepSeek AI from China and with President Donald Trump imposing a high tariff to imported goods with the intent of increasing the internal economy of the US. And we have not forgotten the impact of the Ukraine and Russia war to the global economy. Most investors fear that the crash is deeper than anticipated, while 1% of investors sees this as another bull run, just like it was after the COVID-19 lockdown. How do we take advantage of this? What do we do to brace ourselves for this great opportunity? This is what we will discuss in today's video. But first, why is this chaos happening and why should we care? Right from the campaign of Donald Trump, he has promised to make America great by selling these dreams of citizens keeping more cash than they pay in insurance. It looks like before he can achieve those dreams, he has gathered himself a friend name like sharks, lions and reptiles by imposing a high tariff on importation from China, Canada, Mexico and other countries. And most of these countries has responded.
Chris and Mary, good morning. Overnight, just as those tariffs on Chinese goods went into effect, Beijing responded with a series of retaliatory countermeasures of its own, affecting a variety of U.S. products. Those include a 15% tariff on coal and liquefied natural gas products and a 10% tariff on crude oil, farm equipment, and large engine cars imported from the U.S.
But let's think like Trump for a second. Let's use this scenario. Two YouTubers wants to make a content that will be consumed by US population. First YouTuber, let's call it Trump A, buys his YouTube setup like the mic, the camera, the lighting as a US manufactured product. Second YouTuber, let's call it Trump B, buys the same setup but this time from a manufacturer outside the US. If both of these YouTubers plans to increase US economy using their YouTube business, which of these guys do you think will have more impact on US economy? Yeah, you got it right. The first one. This is because starting from the purchase of the equipment to the consumption, all is US based, and this is called instant monopoly. With the population of the United States around 340 million, 80% of the gross product are attributed to domestic content, while almost half of the manufacturers depends on products from other countries. 20% of the products made in the US use parts from other countries, while 48% of the products people buy comes from other countries. This is to say that the United States is leaving 68% of the domestic fund to other countries every year. If that sounds right, that is to say that the Messiah has come to save us all. So let's relax and enjoy the ride. But with S&P 500 down by 8.5% and with Donald Trump interview on possible recession.
Are you expecting a recession this year?
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time.
We are too far from the promised land. With the outlook of the market, it looks like we are heading to a stock crash to about 6 to 12 months. But the good news is, we are not Trump done yet. With Elon Musk acting as the senior advisor to the department, have released a statement saying that they have managed to save a huge sum of $105 billion in less than 2 months. With the news reporting that Honda to produce next Civic in Indiana, not Mexico, and with Apple commenting to invest 500 billion US investment into advanced manufacturing in Texas, and with the pharmaceutical company Eli Lilly plan to set up 27 billion in new US manufacturing investments. It looks like we are gradually making progress as companies are setting plans to mitigate this high tariff. But as you all know, the walls of Jericho are not built in one day. Companies need to deal with planning, regulation, permits, construction, equipment, staffing and training, validation, quality assurance, a whole lot which could take at least 3 to 6 years to complete. This is why the global economy is wambling in panic. And I get it, human mind does not like panic and uncertainty. The same as the stock markets, which moves in wave and have returned plus 20% last year. Right now, we might be experiencing a period of pullback and rebalancing. As the law of gravity says, what goes up must surely come down. But enough of these foreign stories. Let's head to England, with the Bank of England dropping interest rates to 4.5%. The bank is sending a message to stimulate economic activities and to support growth by making borrowing cheaper. Lower interest rates encourages businesses to invest and consumers to spend more. A rate cut could boost consumer confidence, increase more hiring and wage growth, and can as well drive stock prices very high. However, if rates are cut too much or too quickly, it could overheat the economy, drive inflation very high. With inflation around 3%, some big financial institutes like Morgan Stanley and Goldman Sachs has predicted at least 5 cuts, bringing the rates to 3.5 by the end of 2025. Let's see how the interest rate cut could affect our savings. Take for example, if you borrow £10,000 in October 2024 at an interest rate of about 4.9% per year for the term of 5 years, with monthly payment of £188.25, the total amount paid over 5 years will be £11,295.27, and the total interest you pay will be £1,295.27. Using the same example, if you borrow £10,000 in October 2024 at an interest rate of 4.90% a year, assuming the interest rate is changing to 4.70 from February 2025 onward, your new monthly payment from February 2025 onward will be £187.40, and the total amount paid over the 5 years will be £11,247.33, and the total interest paid will be £1,247.33. To get the difference between the two, minus £1,295.27 to £1,247.33, it will leave you with a jackpot of £47.94 gain as a result of interest rate cuts. But on the flip side, the UK government have increased the rate of national insurance, which will take effect on the 6th of April, from 13% to 15%. Also, the cut of secondary threshold, which mandate employers to contribute £9,100 yearly to £5,000 a year. This news has sent a mixed reaction among UK businesses, especially the SMEs, which contributes 6 to 70% to the UK economy. Let's see what Richard Rees has to say about this.
Working people will not see higher taxes in their payslips as a result of the choices that I am making today. That is a promise made and a promise fulfilled. But any responsible Chancellor would need to make difficult decisions today to raise the revenues required to fund our public services and to restore economic stability. So in today's budget, I am announcing an increase in employers' national insurance contributions. We will increase the rate of employers' national insurance by 1.2 percentage points.
In the year 2025-2026 tax year, firms will pass on 60% of the high cost of workers and consumers via low real wages and higher prices, and absorb 40% themselves in lower profit, it forecast. Also, according to BBC, leading business news says the budget was a tough one for businesses, pointing to the national insurance hike as a blow to the ability of firms to invest. But wait for a sec. If cutting interest rates helps boost wages, increases demand for goods and services, and helps mortgage and loans for small businesses, and if increase in national insurance will cause employers to lower wages, higher prices, and will cause businesses to leave the UK, and with the UK government owing around 2.7 trillion, economy and standard of living has declined, and the taxman is waiting beside with a jacksaw. This does not make sense if you ask me. But what can we do about this? Again, there is nothing much we can do. Government is government. I believe they have their plans and they are planning towards something better. But the only thing that I will advise or I will do personally is to be in charge of what I can control, like my income, my expenses, and possibly optimize my skills by continuous learning. And for my investment plan, I'll continue to dollar cost average my positions until we are back in green. Let me know what your thoughts are in the comment section and hit the subscribe button, and I'll see you all in the next video. Much love.